Hello, and welcome to Freddie Mac Connects, Busting Common Myths on Home Possible session. All lines are in listen-only mode. This presentation is being recorded and will be available following the session. If you have a technical issue, please use the Q&A box and someone will assist you. Finally, using the handouts icon, you will find links to the speaker's bio and the presentation deck. With that, I will turn it over to Jim Clement, Senior Manager with Client Strategy and Optimization. Jim, the floor is yours.
Thank you, Camden. Welcome, everyone. Today, we'll be covering a number of different topics specifically related to Home Possible. So first, we'll do an overview of Home Possible, how borrowers can open a path to home ownership. We'll address 4 of the most common myths associated with Home Possible. And then we'll also talk about how you can get more out of our affordable products, leveraging Home Possible and other affordable opportunities. So let's start with an overview of Home Possible. Freddie Mac has made homeownership possible for more than 760,000 families through 151 billion, that's billion with a B, in Home Possible originations since 2015. Home Possible offers a number of different features and benefits. It offers flexible sources of down payments through family, maybe a gift, employer assistance programs, secondary financing in the form of an affordable second, or even sweat equity. Home Possible does have income limits, so your borrowers must be less than or equal to 80% of the area median income for the subject property address submitted. There are no geographical limits on loan amounts. Home Possible offers minimum down payment opportunities for borrowers, such as 3% down, so you can have a 97% loan to value, and go up to 105% total loan to value with an affordable second for 1-unit properties. You can also finance a 2 to 4 unit property with a minimum of 5% down, and also go up to that 105% total loan to value with an affordable second. Mortgage insurance. Home Possible offers lower required mortgage insurance coverage for those borrowers putting minimal down payment. With 3% down, the mortgage insurance requirement is only 25% versus 35% of that of a standard conventional mortgage. It can also be canceled on 1-unit properties when the loan balance drops below 80%, unlike FHA. There are a number of different eligible property types that you can use Home Possible. 1 to 4 units, as we addressed 2 to 4s a little bit earlier, condominiums, co-ops, planned unit developments, and manufactured homes with certain restrictions. A lot of opportunities for your borrowers to leverage Home Possible and for you to place your borrower in the most competitive and affordable product that they're eligible for. So let's address some of the Home Possible myths that are out there, and hopefully you will not let them stand in your way of utilizing this product. First, Home Possible is only for first-time home buyers. That is incorrect. First-time home buyers can create opportunities for many types of borrowers, including first-time home buyers and repeat borrowers. And for those repeat borrowers, you can use it in a purchase scenario or a refinance. Home Possible is relevant for our ever-growing condominium market, supports manufactured housing, 2 to 4 units, energy-efficient properties, and many other property types. However, if your borrower is a first-time home buyer and their income exceeds the Home Possible income limits of 80% of the area median income, then you can leverage Freddie Mac's Home One product, which provides very similar benefits to Home Possible, however, does not have that income restriction like Home Possible. So for first-time home buyers who exceed the income limit of Home Possible, look to Home One as a financing alternative. Our second myth. Home Possible requires the borrower to have 3% of their own funds in the transaction. That is also incorrect. Home Possible provides flexibilities in how borrowers can source funds for their down payment and closing costs. most of the scenarios where you would utilize Home Possible would not require the borrower to have 3% of their own funds in the transaction. However, there are two, and we'll address them. If your borrower is financing a one-unit manufactured property where they're getting a grant from the lender or an agency affiliated with the lender, then 3% of their own funds or personal funds are required in the transaction. Also, if your borrower is purchasing a 2 to 4 unit primary residence with less than 20% down payment, then your borrower is also required to have 3% of their own personal funds in the transaction. Let's look at what other types of funds can be utilized to complete a Home Possible mortgage. So borrower's personal funds, the different asset types would be depository accounts, funds from a trust, securities, retirement accounts, government bonds, loans secured by the borrower's assets, a borrower's real estate commission, sale of borrower's assets, sale of borrower's real property, cash value of a life insurance policy, and cash on hand. Cash on hand is unique to Home Possible. So for those borrowers who do not utilize traditional checking and savings accounts, based on eligibility criteria, they could potentially use cash on hand to complete the transaction. Other eligible sources of funds are gift funds or gift of equity from a related person, gift funds from a wedding. So if you recently were married, you can utilize your wedding gifts as a source of funds to complete the transaction, a gift or grant from an agency, a gift and grant from the seller as the originating lender, affordable second, so down payment assistance, very popular with Home Possible, as well as employer-assisted home ownership benefits or sweat equity. A lot of different sources of funds that can be utilized to complete the mortgage transaction and hopefully give your borrower the opportunity of home ownership. The next myth, homebuyer education is always required when using Home Possible. This is also incorrect. If all borrowers, all occupying borrowers on the loan are first-time homebuyers, at least one of those borrowers must participate in a homeownership education program prior to the note date or prior to the effective date of the permanent financing for construction or renovation mortgages. Repeat buyers do not have to participate. So in a scenario where you have two borrowers on your loan, one borrower is a first-time homebuyer, your other borrower is a repeat borrower, then neither borrower needs to participate in a home buyer education program. The one keynote I will make is for those repeat borrowers, you cannot have more than one other mortgage property at the time of closing. So your new property, which you're using Home Possible, plus one other property is the maximum. So again, for your repeat borrowers, they do not have to participate in home buyer education, and it's only if all borrowers on the loan are first-time homebuyers. And if your borrower does need to participate in a homeownership education program, there are a lot of different options out there. There are HUD-approved counseling agencies, housing finance agencies, community development financial institutions, mortgage insurance companies, and then other industry programs that are available. But one I would like to highlight is our Freddie Mac Credit Smart Homebuyer U. It offers a free online interactive learning path for homeownership education. Again, it's free for all participants. It's available in English and Spanish. It satisfies the homeownership education requirements for Home Possible, Home One, and HFA Advantage. And one other nice note for you loan officers out there, your borrower can input your email address into the Credit Smart Homebuyer U education program. And when they complete the program, the completion certificate for that homebuyer education will be emailed directly to you without prompting or without having to ask the borrower or without having to follow up for that documentation. So hopefully that will make it a little more efficient and you can move that borrower along to closing as quickly as possible upon completion. Our next myth, Home Possible is only for borrowers with a small or low down payment. That is also incorrect. There are no minimum down payment or maximum down payment requirements. So no LTV or TLTV. You can put as much money down and utilize a Home Possible mortgage where applicable. clients can save money on mortgage insurance. So even if you're putting 10% down versus a minimum of 3%, you can still save on a reduced mortgage insurance coverage for your borrowers. And when borrowers utilize Home Possible, they are eligible for our credit fee caps. So 0 credit fees in price for borrowers utilizing Home Possible Mortgage. With one caveat, if you are utilizing a custom MI for your borrower, so that would have fees associated with it, they are not included in the cap, but all other fees are. So anything related to credit score, loan to value, or special attributes are all included in the credit fee caps. So for example, if you have a borrower who's buying a condo, they're a repeat borrower, and they're putting 20% down, they are eligible for the credit fee caps in Home Possible. So any add-on for LTV, credit score, or that condo fee add-on, they are all covered in your 0 credit fee caps. So this could really provide borrowers with the most competitive and affordable mortgage product they're eligible for, even in scenarios that you may not think would be your typical or traditional Home Possible scenario. So if that's a buyer, it can absolutely help them obtain a very competitive mortgage and affordable product. So let's talk a little bit about how to get more out of your affordable products, taking Home Possible to the next level to drive more business. Choice Reno Express is a fantastic product that allows borrowers to make small repairs to the property, either the one they're purchasing or refinancing. So those small scale renovations, the borrower may not have the cash funds available to complete them. Choice Reno Express allows them to finance those small scale renovations into their mortgage. Those renovations or improvements could help improve the loan's value, help the borrower build equity, and it also allows you the flexibility to deliver the mortgage to Freddie Mac before the renovations are complete, without recourse and without pre-approval from Freddie Mac. So it's a great product. It's very flexible. It's very easy to use. And it can also be combined with Home Possible, Home One, HFA Advantage to offer the benefits of those 3 products from affordable and competitive perspective, as well as the flexibility to address any type of small repairs or condition-related improvements that the borrower would like to make on the property. So a really great product, and it can be combined with other affordable products to really put your borrower in a great position to achieve home ownership. Another great program or product is our HFA Advantage, and this is offered exclusively through our housing finance agencies. It's a conventional product which offers a lot of the great benefits of Home Possible. 3% down on a 1-unit property with the opportunity to go up to 105% TLTV with an affordable second. 2 to 4 unit, 5% down, again, same as Home Possible. Non-occupying borrowers are permitted. Manufacturing homes are permitted, all with the added benefit of that down payment assistance from the housing finance agency. So if your borrower is struggling to come up or secure the required funds to complete a mortgage transaction, looking to a housing finance agency and some of their programs or products could help the borrower remove that obstacle and prepare for purchasing a home. Repeat and first-time home buyers are eligible. The HFA sets the income limits for HFA Advantage, so it doesn't have the hard restriction of 80% of the area median income like Home Possible. The HFA also determines the home buyer education requirements. And one additional item that HFA Advantage offers for borrowers who are less than that 80% of the area median income, it offers charter level mortgage insurance. So with only 3% down and your borrower less than or equal to 80% of the area median income, the mortgage insurance coverage requirement is only 18% versus 25% on Home Possible and 35% on a standard conventional mortgage. that could offer some significant savings in monthly payment for your borrowers. Additionally, HFA Advantage borrowers are also eligible for our zero credit fee caps. So no credit fees in price for borrowers utilizing HFA Advantage, with the one caveat of the custom mortgage insurance that would not be included in the credit fee cap if being used. So let's look at the differences and similarities between Home Possible and HFA Advantage. So we'll go right down the center in green. So they both offer the opportunity to put 3% down and go up to 105 total loan to value with an affordable second. The mortgage insurance is cancelable, unlike FHA. Borrowers can own one other property at the time of closing, so the new mortgage plus one other. It offers the same flexible source of funds. It allows 2 to 4 units in manufactured properties, and non-occupant borrowers are allowed. So the difference is Home Possible, as stated, has an income restriction of 80% of the area median income. Only qualifying income is used, and your mortgage insurance coverage with 3% down is 25% versus 35% on a standard conventional mortgage. And then for HFA Advantage, so as a participating lender, you must be participating with an HFA and utilizing their product, an HFA Advantage. Each HFA sets the income limits and requirements. Each HFA must offer their own down payment assistance program. As stated, it offers charter level MI for those borrowers less than or equal to 80% of the area median income versus 35% on a standard mortgage. And the HFA establishes the homeownership education requirements for their particular product. So we've covered a lot of information today. Home Possible, HFA Advantage, combining it with some of our other affordable products such as Choice Renovation Express, can really offer your borrower a very competitive and affordable product. Where eligible and where utilized, it could set you apart as a lender from a competitive situation, as well as earning your borrower's trust and putting him in a product that best meets their needs. So hopefully you have taken a lot from today's conversation and presentation, and go back and look at some of these programs a little more in depth and see if you have any borrowers that could benefit from them today. Thank you so much for attending. And Camden, I'll send it back to you.
Thank you, Jim, for your great presentation. For our guests, your opinion is important. Please take a few moments to take our brief survey so that we can continue to bring you timely and relevant content. The presentation deck will be sent to you following the session. You can also log in anytime after the conference to play back this or any other session. Thank you for your time and enjoy the rest of the conference.